The Goldilocks era didn't just end this week. It hit a wall of geopolitical reality. For months, the market narrative was fueled by post-New Year euphoria and a resilient U.S. engine. But the script has been rewritten by a sudden surge in fiscal anxiety and geopolitical friction. While U.S. macro fundamentals are screaming strength, headlined by a robust 4.4% GDP growth, the market is currently obsessed with theatrics over fundamentals. We are witnessing a classic transition from blind optimism to a necessary reality check, where political unpredictability has become the primary headwind. In 2026, growth has become a secondary concern. The market is pricing in a theatrics premium, signaling that investors are more worried about the next headline out of DC or Tokyo than they are encouraged by 4.4% GDP. This isn't a collapse, but a vital recalibration. The story has shifted from how high can we go to how much noise can we withstand. While the headlines look dire, a look at the actual tape suggests the damage is more of a calculated retreat than a full-scale rout. If you looked at the screens this week, you saw a sea of red, but the macro storyteller sees a different picture, a necessary breather. The S&P 500 dipped a marginal 0.35%, and the DAX slid 1.57%. Yet amidst this equity exhaustion, there was a glaring, defiant outlier, the Shanghai Index, which climbed plus 0.84%. This divergence suggests that while the West is panicking over policy, the East is playing a different game. Meanwhile, the real action wasn't in stocks, but in the metals mania currently gripping the pits. Gold hitting $4,980 per ounce and silver breaching the historic psychological $100 per ounce milestone aren't just price spikes, they are safe haven sirens. When capital flees to metals at this scale, it's a vote of no confidence in the soft landing narrative. Investors are buying insurance because the world has become too volatile to navigate unhedged. To understand why the safe haven sirens are wailing, we have to look at the actors currently dominating the global stage. In 2026, the cost of doing business includes a theatrics premium, a volatility tax levied by political unpredictability. West, President Trump's announcement of new tariffs on Europe tied to a diplomatic standoff over Greenland sent the S&P 500 into its worst single-day drop since October. The absurdity of the link didn't matter. The threat of a trade war with the EU did. East, PM Takaichi's surprise election call and her radical 0% food consumption tax pledge have essentially set the Japanese fiscal house on fire. We're seeing a stark contrast, a softening stance in the U.S. following the initial tariff shock versus a genuine fiscal credibility crisis in Japan. These aren't just noise, they are the direct drivers of market exhaustion. When politics enters the realm of the unthinkable, like 0% tax pledges or Greenland-based trade wars, the market stops looking at earnings and starts looking for the exit. This political instability is colliding with an even more persistent foe, the paradox of sticky inflation. We are in the last mile of the inflation fight, and it's proving to be a marathon. The paradox of 2026 is that our greatest strength is also our greatest weakness. The resilient 4.4% GDP growth is the very thing trapping central banks. With core PCE stuck at a sticky 2.8%, well above the 2.0% target, the Goldilocks ending is being aggressively rewritten in real time. Look at the UK CPI surprise of 3.4%. It was the canary in the coal mine for this week, signaling that inflation isn't just sticky, it's stubborn. This delayed Bank of England rate cuts and served as the primary catalyst for the metals mania. Investors are piling into gold, $4,980, because they've realized that central banks are paralyzed. They cannot cut rates into a 4.4% growth environment without risking an inflationary spiral.
Despite this global paralysis, the U.S. remains the resilience, if misunderstood, outlier. There is a massive divergence between the fear on Wall Street and the reality on Main Street. While the S&P Sentiment Index is plummeting, the economic engine is actually running hot. Q3 GDP was revised up to 4.4%, fueled by exports and investment, and jobless claims have hit historic lows at 200,000. The disconnect is the story. Investors are ignoring the fact that the U.S. labor market is fundamentally indestructible because they are terrified of the Fed's shadow. The 2.8% core PCE is the only number that seems to matter to the market right now. This divergence creates a dangerous vacuum where good economic news is treated as a bad policy omen, leading to irrational volatility. If the U.S. is a hot engine, the Eurozone is a cold tightrope. Europe is currently caught in a delicate balance between stabilization and stagnation. We see a glimmer of hope in the Eurozone PMI, 51.5, and a 20-month high in business optimism, but that is being canceled out by structural cracks. The UK is facing a 5-year unemployment high, 5.1%, and the looming threat of U.S. tariffs on European goods has brought the Mercosur trade pact to a grinding halt. Europe isn't falling, but it is effectively stagnating. The recovery is a house of cards that could be blown over by the next tweet regarding transatlantic tariffs. Cautious pragmatism is the only viable lens here. The tightrope between modest expansion and a tariff-induced recession is narrowing by the day. While Europe stagnates, the most dramatic fiscal shift is happening in the Japanese bond market. This week, political ambition collided head-on with fiscal reality in Tokyo. PM Takaichi's unfunded tax cut pledge has officially woken the bond vigilantes. JGB yields have spiked to 2.26%, a 29-year high not seen since 1995. This isn't just a local spike, it is the death of the low-rate era for the world's largest creditor nation. This is a fiscal contagion risk of the highest order. The BOJ is desperately trying to hold rates at 0.75%, but the market is no longer listening. When Japanese yields spike to nearly 30-year highs, the global interest rate floor rises. This puts immense upward pressure on yields in the US and Europe, complicating the path for every other central bank on the planet. While Japan grapples with a bond market rebellion, its neighbor across the sea is dealing with the opposite problem, a growth engine that looks impressive on paper but is hollow at the core. Beijing claims a 5% growth target for 2025 has been met, but this headline success masks an internal decay. The data reveals a massive structural imbalance. Industrial production is humming at plus 5.2%, export-driven, while retail sales are languishing at a dismal plus 0.9%. Without a massive stimulus package, 2026 looks incredibly tough for China. The export-driven model is hitting a wall of global trade friction, exemplified by the tariff talk in the West, and it is failing to spark domestic demand. The Q4 growth slowdown to 4.5% is the real signal. The momentum is gone, and the hollow victory of 5% will soon be forgotten in a difficult Q1. This global friction sets the stage for a high-stakes week of data. We are entering a high-variance environment. From January 26 to 30, the market will be looking for a heartbeat of clarity in a sea of noise. Monday, 26, U.S. durable goods, Germany IFO business climate, the European sentiment anchor. Tuesday, 27, U.S. consumer confidence,
Case-Shiller home prices, the real estate reality check. Wednesday, 28, the pivot, the Fed decision and Powell's press conference. Thursday, 29, Japan consumer confidence, US jobless claims. Friday, 30, US PPI, the ultimate inflation tell, Eurozone GDP flash. Powell's press conference on Wednesday is the only event that matters. It isn't just a speech, it is the clarity the market is starving for. If Powell remains hawkish in the face of 2.8% PCE, expect the metals mania to accelerate. Before we position, we must audit the threats. Understanding the likelihood versus severity is the difference between surviving and thriving in this volatility. 1. Fed hawkishness, high likelihood. If Powell refuses to acknowledge the market's need for a pivot, risk appetite will evaporate. 2. Sticky US PPI, high likelihood. An upside surprise on Friday is the reset button for all rate cut bets and could cause a structural break. 3. Japan fiscal contagion, medium likelihood. A continued spike in JGB yields would force a global upward repricing of risk. 4. Eurozone recession, medium likelihood. A weak GDP flash on Friday could rattle any remaining ECB easing hopes. 5. China consumer slump, low-medium likelihood. A failure to stimulate domestic demand will lead to a broader Asian slowdown. Most of these are noise, but the Friday PPI is the potential structural break. If that number comes in hot, the 2026 investment thesis requires a total overhaul. The theme for the week is recalibration. We are witnessing a collision between soft landing hopes and sticky inflation reality, all wrapped in a layer of geopolitical theater. In an environment of such high variance, patience is not just a virtue, it is the most profitable strategy. Avoid aggressive positioning until Wednesday's Fed clarity. The disconnect between economic fundamentals and market sentiment is vast. Let the data do the talking. Let the central banks show their hand. We will wait for the theatrics to subside before we commit capital to the next leg of the 2026 story. Stay disciplined, stay hedged, wait for the signal. If you found this analysis useful, help us create more content like this by liking the video and subscribing to the channel. You can also claim the PowerPoint slides for free.